March 12, 2023, New York City. State regulators closed Signature Bank and appointed the Federal Deposit Insurance Corporation as receiver. The institution held roughly $110 billion in assets. By the time markets opened on Monday, it was the third largest bank failure in United States history. The collapse came just 2 days after Silicon Valley Bank was seized in California. Confidence across regional banks was already fragile. Signature's failure added urgency to an unfolding crisis. To understand how a bank with more than $100 billion in assets unraveled in days, you have to step back to its business model and growth strategy. Signature Bank was founded in 2001 with a focus on relationship-based commercial banking. It targeted privately owned businesses, professional services firms, and high-net-worth clients. The bank emphasized personalized service and decentralized decision-making through team-based client groups. For years, the model generated steady expansion. According to regulatory filings, Signature's assets grew significantly during the 2010s. By 2019, its total assets exceeded $50 billion. The bank's deposit base was concentrated among commercial clients rather than traditional retail customers. Then a new segment accelerated growth, beginning around 2018 and intensifying through 2020 and 2021. Signature became a significant banking partner for cryptocurrency firms. According to SEC filings and public disclosures, the bank launched a digital payments platform called Signet, which allowed real-time transfers for institutional clients. The crypto sector's expansion during 2020 and 2021 drove deposit growth. By the end of 2022, according to regulatory disclosures, Signature's total assets were approximately $110 billion. And deposits had surged during the peak of digital asset market activity. A substantial portion of those deposits were linked to crypto-related businesses. The incentives were understandable. Traditional banking margins were under pressure during the prolonged low-interest rate environment. Crypto clients often held large cash balances. Real-time settlement services created a competitive niche. Rapid deposit growth increased scale and fee income, but concentration risk grew quietly. Deposits from digital asset firms can be volatile. When crypto markets are expanding, cash balances rise. When markets contract or regulatory scrutiny intensifies, balances can fall quickly. In 2022, cryptocurrency prices declined sharply. Several high-profile digital asset firms entered bankruptcy, according to public reporting and regulatory filings. Signature reduced its exposure to the crypto sector late in 2022 and announced plans to limit digital asset-related deposits. The bank stated publicly that it intended to reduce reliance on that segment. At the same time, the broader interest rate environment shifted. Throughout 2022, the Federal Reserve raised policy rates aggressively to combat inflation. Rising rates affect banks in multiple ways. They increase funding costs. They reduce the market value of fixed-income securities. They can pressure borrowers. Signature, like many regional banks, held investment securities that declined in value as rates rose. According to regulatory filings, unrealized losses on available-for-sale securities increased across the industry. The structure of funding also mattered. A significant portion of Signature's deposits exceeded the $250,000 FDIC insurance limit. According to disclosures after the failure, uninsured deposits represented a large share of total deposits. In calm conditions, uninsured commercial clients may remain stable. In stressed conditions, they have strong incentives to move funds quickly. In early March 2023, Silicon Valley Bank failed after experiencing a rapid deposit run. The event heightened scrutiny of banks with high uninsured deposit ratios and sector concentration. Signature's stock price declined sharply in the days following SVB's collapse. Market participants questioned exposure to crypto clients and liquidity stability. Deposit outflows accelerated. According to later regulatory statements, customers withdrew billions of dollars in deposits over a short period. The scale of withdrawals, combined with broader market stress, strained liquidity. On March 12, 2023, the New York State Department of Financial Services closed the bank, citing a systemic risk exception similar to the action taken with Silicon Valley Bank. The FDIC was appointed receiver. The federal government announced that all depositors, including those with balances above the insured limit, would have full access to their funds. The decision was framed as necessary to preserve financial stability. The $110 billion balance sheet had unraveled within days. The rise of Signature Bank reflected growth in relationship banking and digital asset services. The speed of its collapse reflected concentrated funding, uninsured deposits, and confidence shock during a broader regional banking crisis. By March 10, 2023, the pressure on Signature Bank was no longer about headlines. It was about liquidity mechanics. The failure of Silicon Valley Bank had already shaken depositor confidence across the regional banking sector. Investors and corporate treasurers began reviewing exposure to uninsured deposits and sector concentration. Signature fit that profile. According to regulatory filings from year-end 2022, a substantial portion of Signature's deposits were uninsured. Commercial clients and institutional customers held balances well above the $250,000 FDIC cap. In normal market conditions, those clients value transaction services and relationship banking. In stressed conditions, liquidity becomes the priority. Deposit concentration amplifies behavioral shifts. Unlike a diversified retail deposit base composed of millions of small accounts, Signature's funding was weighted toward larger balances. When large depositors decide to move funds, the scale is immediate and significant. At the same time, the bank's exposure to the digital asset sector created additional perception risk. Throughout 2022, cryptocurrency markets declined sharply. Several prominent crypto firms entered bankruptcy, although Signature publicly stated that it was reducing digital asset-related deposits and limiting new exposure. Market participants associated the institution with crypto volatility. Perception can move faster than financial statements, according to statements released after the seizure. Deposit withdrawals accelerated rapidly over the weekend following Silicon Valley Bank's collapse. The New York State Department of Financial Services stated that it closed Signature to protect depositors and preserve stability. Liquidity is a daily equation. Banks hold reserves and liquid securities to meet withdrawals. They can also borrow from the Federal Reserve's discount window or other facilities. But if outflows accelerate beyond available liquidity buffers, regulators intervene. Signature's balance sheet included securities and loans similar to other regional banks. Rising interest rates during 2022 had reduced the market value of fixed-income securities across the industry. While unrealized losses do not necessarily force sales, they limit flexibility if assets must be liquidated quickly. In a stress scenario, funding costs rise and asset liquidity declines simultaneously. On March 12, 2023, regulators determined that closing the bank was necessary. The FDIC created Signature Bridge Bank to maintain operations. Shortly thereafter, substantial portions of the bank's deposits and assets were sold to Flagstar Bank, subsidiary of New York Community Bancorp. According to FDIC press releases, the decision to protect uninsured depositors reflected a broader policy response. Federal authorities invoked a systemic risk exception, the same mechanism used days earlier for Silicon Valley Bank. The Treasury Department, Federal Reserve, and FDIC issued a joint statement that all depositors would be made whole to prevent contagion. This marked a significant step. Ordinarily, uninsured depositors bear risk in bank failures. In March 2023, policymakers judged that broader confidence concerns required full depositor protection. Behavioral dynamics were central. Once depositors observe one regional bank fail, they reassess others with similar characteristics. Concentrated uninsured deposits become a focal point. Digital transfer capability compresses the timeline of withdrawals from weeks to hours. Signature's management had previously emphasized diversification efforts. According to public statements in late 2022, the bank intended to reduce digital asset deposits by billions of dollars. But structural repositioning takes time. The events of early March unfolded in days. Supervisory reviews began immediately. In congressional testimony following the crisis, regulators acknowledged that interest rate risk and deposit concentration across mid-sized banks required closer monitoring. While Signature's failure was not attributed to fraud, oversight agencies examined liquidity planning and stress testing assumptions. The systemic environment amplified vulnerability. The Federal Reserve had raised interest rates at the fastest pace in decades. Bond values declined. Funding costs increased. Market volatility was elevated. Under those conditions, confidence shocks carry greater weight. The $110 billion asset size was not, by itself, the cause of failure. The combination of concentrated uninsured funding, sector exposure perception, and rapid withdrawal dynamics proved decisive. In a networked financial system, stability depends on confidence as much as capital. March 13, 2023. When markets opened on Monday morning, Signature Bank no longer existed as an independent institution. Instead, the FDIC operated a temporary entity called Signature Bridge Bank to ensure continuity of services. Depositors had access to their funds. Branches reopened under federal control. The speed of the resolution was deliberate. According to official FDIC releases, regulators acted over the weekend to prevent further destabilization of regional banks. The decision to protect all depositors, including those above the standard $250,000 insurance limit, was framed as necessary to preserve broader financial stability. This marked one of the most significant policy actions of the 2023 banking stress episode. Ordinarily, uninsured depositors bear potential losses in a bank failure. In this case, federal authorities invoked the systemic risk exception under existing law. The Treasury Secretary, Federal Reserve, and FDIC approved the determination. The message was clear: prevent contagion. Shortly after the seizure, the FDIC initiated a bidding process to sell Signature's assets and deposits. On March 19, 2023, regulators announced that Flagstar Bank, a subsidiary of New York Community Bancorp, would acquire most of Signature's deposits and certain loan portfolios. According to FDIC statements, approximately $38 billion in deposits and a substantial portion of loans were transferred. Certain digital asset-related deposits were excluded from the sale. The FDIC estimated that the failure would cost the Deposit Insurance Fund approximately $2.5 billion, a figure disclosed in public releases. The resolution was structured to minimize disruption to customers and counterparties. But broader questions followed. First, the role of digital asset concentration. Although regulators did not formally attribute the failure solely to crypto exposure, the bank's association with the digital asset sector shaped depositor perception. In a period of heightened scrutiny, concentration risk became a vulnerability. Deposit insurance structure. The decision to protect uninsured depositors at both Signature and Silicon Valley Bank sparked debate in Washington. Policymakers discussed whether deposit insurance limits should be reconsidered, particularly for commercial accounts that hold payroll and operational funds. Third, supervisory oversight. In subsequent hearings, regulators reviewed liquidity stress testing for mid-sized banks. While Signature was not among the largest institutions subject to the most stringent capital standards, its asset size exceeded $100 billion. Lawmakers questioned whether enhanced stress scenarios should apply more broadly. According to public testimony, regulators emphasized that rapid deposit outflows, rather than insolvency from credit losses, drove the decision to close the bank. This distinction matters. Signature did not collapse because of massive loan defaults. It collapsed because liquidity evaporated quickly in an environment of sector-wide distrust. In modern banking, liquidity risk can be decisive even when capital ratios appear compliant days earlier. Behavioral dynamics amplified the shock. Commercial clients monitor news in real time. Financial advisors communicate instantly. Digital platforms allow large-scale transfers within minutes. Once a narrative of instability forms, withdrawal behavior can accelerate exponentially. Structural incentives also played a role. Serving crypto clients during a period of industry growth offered scale and fee income. Expanding commercial relationships increased deposits. In a low-interest rate environment, growth was rewarded by markets. But growth concentrated in one volatile sector carries embedded risk. When that sector contracts, funding volatility follows. Regulatory frameworks continue to evolve. In the months following the failure, federal agencies issued proposals to strengthen capital and liquidity standards for certain regional banks. Discussions included higher capital buffers and more rigorous liquidity coverage requirements. Signature's collapse did not trigger a systemic financial crisis. The broader banking system remained stable. Large banks maintained capital strength. Emergency liquidity programs from the Federal Reserve provided backstop support. However, the episode underscored a fundamental shift. In a digital era, deposit flight can occur in days rather than months. Funding models dependent on large uninsured balances require robust contingency planning. Confidence management has become as critical as asset quality. The $110 billion bank that failed in days reflected modern banking realities. Asset size alone does not guarantee stability. Sector concentration, funding structure, interest rate environment, and depositor psychology intersect under stress. Understanding how Signature Bank collapsed provides context for how regulators, executives, and investors now assess liquidity risk in a high-speed financial system. If you value carefully sourced analysis of financial events and regulatory evolution, consider subscribing to the channel for future documentaries.